I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino. John is the author of several books on the economy, including The Money Bubble. His website is dollarcollapse.com. Welcome back to the show, John.
Hey, Jim. How's it going?
It's going great in Vancouver. What about yourself?
It's going great in Idaho. And I'm looking forward to visiting you one of these days up in Vancouver. Great city.
Yes, as long as you're not thinking of buying a house.
No.
In which case you should bring millions of your little greenback friends. Millions and millions.
I'm not even thinking of renting. I want to stay with you to save money.
John, right now it looks like negative interest rates in Europe, Japan, really discouraging for people who are looking for long-term investment. Can you maybe explain?
This was a really interesting week on that count because German 10-year bonds went negative for the first time ever. So now from overnight money all the way out to 10 years, if you want to own German government paper, you have to pay them. And that happens in addition to the same thing in Japan and negative yields for a lot of other European countries. So now we've got $10 trillion plus of government paper trading with negative yields in the world, and 16, I think at last count, corporate bond issues in Europe trading with negative yields. And so the question is, how far behind in this trend could U.S. Treasuries be? Our rates are falling here, and with Brexit, the possibility of the United Kingdom leaving the European Union in the referendum that is due a couple of weeks hence, everybody in Europe is spooked, and by implication, the rest of the world is kind of worried about this because they don't know whether this is going to be really disruptive or not. And so money is presumably starting to flow into the U.S. in search of a safe haven. So it could be that this forces our interest rates down to negative levels, too. And, Jim, this is just really dangerous. Because there are some things that seem revolutionary but aren't, like, the legalization of marijuana or gay marriage or something like that. Those things, to a lot of people, seem very radical, but they actually don't really make much of a difference, and they're probably, on balance, beneficial. And so they're not that big of a deal in the long run. Normal life goes on. In fact, it's improved a little by changes like that. But negative interest rates, which also seem revolutionary, actually are revolutionary because they turn capitalism on its head. To paraphrase John Maynard Keynes, fair becomes foul and foul becomes fair because foul is profitable and fair is not. And foul in this case is borrowing, Traditionally, we have considered borrowing money to be a bad thing on balance if you do too much of it, and saving money to be a good thing because it builds capital. Well, in a negative interest rate world, borrowing money is profitable because they pay you to borrow. In other words, if there's a negative interest rate and you borrow money, instead of you sending your creditors money, they send you money. And so your net worth goes up when you borrow. Or for a government, the budget gets closer to balance the higher their deficit. And for savers, the more money you put away, the more money you lose over time. And this is incredibly destructive, because it takes away all the old limitations on hubris on the part of governments and corporations. Now if we're telling them borrow as much as you want and we will reward you for it, horrible things are going to ensue. So this is setting the stage for the, financial crisis that's just beyond anything we've ever seen before, because we've never created these conditions, and we've never created an incentive for this kind of moral hazard in the past. So I can't stress what a disaster a global regime of negative interest rates would be.
If negative interest rates were such a good idea, how come in the last 10,000 years of recorded human history we've never done it before?
Yeah, that's a good point, Jim. This has never happened. It seems like it's starting to seem normal to people now because we've kind of been in this world for the last year or so. But it's actually unique in human history. We've never had widespread negative interest rates before. And the reason for that is because we've never had all the world's major governments be armed with unlimited fiat currency printing presses before. And so when we set up that regime in 1971, when the world left the last vestiges of the gold standard, people who understood human nature and economics could have predicted that we'd end up with massive increasing debt around the world and rising incentives for currency debasement and devaluation and, just generally a huge financial crisis. That could have been predicted back then when you said, oh yeah, let's give all the world's governments unlimited printing press. Most people didn't predict it, but we have gotten it. That's where we are. And the fact that we're doing crazier and crazier things to try to keep this unworkable system together means that at some point it fails. At some point even crazy stuff like governments buying back or central banks buying back all of a government's bonds and then some, or pushing interest rates down to negative territory. These are things that are crazy and destructive and at best short-term solutions to some kind of a problem that can be fixed and we go back to normal times. Well, these aren't normal times. We're not going to go back to normal times because we can't fix our problems. And trying to keep the game going with stuff like negative interest rates will just create the conditions for an even bigger crisis down the road. So here we are, right on the verge of something that literally has never happened in human history, and when it happens, when it blows up on us, is going to be so bad that it's almost unbelievable to most people.
What is the rationale of negative interest rates?
Well, the idea of lower interest rates is that it incents people to borrow. If you want companies and individuals to borrow money and spend it to get the economy moving, then you lower interest rates. That's what we've always done. And traditionally it's worked reasonably well. Somebody offers you a 2% mortgage rate, pretty good chance you'll take it, right? And either refinance your own mortgage or buy a new house with it. Well, when you get to a certain point where you've encouraged people to borrow so much money in the past that no amount of new borrowing generates acceptable growth, and then you respond to that with the same tool, push interest rates down further and further and further, you end up pushing interest rates down into negative territory because that's all you've got. That's your only tool. And that's what these clueless, blind governments around the world are doing now, because this is all they know. And so when things are unacceptably slow growing, their only response is to push down rates further. It's like the old saying, if your only tool is a hammer, then every problem looks like a nail to you, right? Because that's all you've got to work with. And so that's really all these guys have to work with. And so they keep doing it. They keep doing the same thing over and over again. And we've reached the point of absurdity now where we're paying people to borrow money, and they're still not borrowing money. The only people borrowing lots of money now are governments because they don't care. But individuals are looking around and going, well, okay, I could take out a mortgage at 3.5%, but then I'd owe that mortgage, and I don't have enough income to really cover what it would cost to do that, so I'm just not going to do it. Or I could buy a new car and take out an 8-year mortgage at 2% on it, but then I'd be making payments for the next 8 years, and that car would be depreciating faster than my loan would be paid off. So is that a good deal? No, I don't think so. And so people just aren't responding the way they previously responded to lower interest rates, because negative interest rates are a whole different thing. And so here we are. Crazy times are about to ensue.
Well, negative interest rates in Japan have made the biggest bank in Japan refuse to sell government bonds because it would lose money.
Yeah, you're seeing people not want to borrow and not want to put their money in the bank because the bank charges you. So they're taking money out of the bank and putting it in home safes. And the big banks don't want to participate in the government bond markets because they lose money. They're holding inventory with a negative rate, which means they lose money on their inventory. So how do you make a market in that kind of an environment? You can't really without losing money. And so the big banks are saying, I don't think I want to play this game anymore. So gradually, more and more people are withdrawing from the financial markets. And there will come a time when this trickle becomes a torrent. And at that point, the central banks will have lost control. And then all hell will break loose, Jim. It's really not clear what happens at that point. But it's going to be bad because panic will be the dominant emotion in the markets, and that's never a good thing. That's never something that is comfortable for somebody trying to gradually, over long periods of time, accumulate wealth in reasonably solid investments. Panic throws that whole calculus out of the window. And that appears to be coming now, because when people won't keep their money in banks, and when big banks won't participate in their government's treasury auctions, then that's the beginning of the end of the process for that system. And clearly we've reached that point.
We'll have more with John Rubino right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with John Rubino. John, the U.S. Fed did not do anything with interest rates today. However, there are still hints that maybe in September they'll boost interest rates. But we have so many economic numbers in the U.S. headed down. What would be the incentive for increasing interest rates this fall?
Well, the Fed wants to increase interest rates for two reasons. One is that it gives them ammunition to lower interest rates later. If they confront an economic downturn right now, and their only tool is to lower interest rates, and they're already at zero, then they have to go negative too, and they don't want to do that if they don't have to. So it's better if they could raise interest rates to like 4%, and then they could cut interest rates by 400 basis points before they hit zero. The other reason is that rates are so low in the U.S. now and around the world that the big banks, which used to profit from lower interest rates, now can't function correctly. Like they're losing money. The profitability of the loans they're making are going down, and their proprietary trading desks aren't making money anymore, and so the big banks are in big trouble. So they're putting pressure on the Fed, which, by the way, they own. The big banks in the U.S. own the Federal Reserve. It's a branch of J.P. Morgan Chase and Goldman Sachs. And so it does the bidding of its owners. And so they're pressuring the Fed to raise interest rates now. So the Fed really wants to. But in this world, when everybody else is cutting interest rates, it's really hard to be the odd man out in a global financial system in that way. And so every time the Fed gets closer to raising interest rates, the financial markets start to freak out. And they pull back and they say, okay, not June. Don't worry about June. Maybe we'll do it in September like they're doing now. And I think that over time it's going to become clear that they can't raise interest rates appreciably ever. Literally not ever. Because there's so much variable rate debt out there that if you raise interest rates, it raises everybody else's interest costs. And you get a financial crisis from that direction. So that's what we're heading for if they raise interest rates. And they know that. I mean, they know that they're kind of in a box that they can't get out of. They're just trying to get by. So when you hear Janet Yellen or any other Fed talking head speak, basically what they're saying is, please don't freak out this week, just infer from what I'm saying whatever you need to hear. and don't sell everything, and just let us see if we can fix this. But they can't fix it. It's going to blow up. The final thing to say about this is that if you went back a decade or 2 decades or whatever and asked a bunch of gold bugs, people who believe in precious metals as a core holding, to design the perfect world in which gold and silver are absolute no-brainers, that's the asset you want to own, they would have designed something like this, where government spending was running through the roof and central banks were monetizing debt in order to allow government debts to be manageable, and interest rates were being pushed down into ever lower territory, and in some cases negative. That's gold bug paradise. And they also would have said that it'll never happen. We'll never get to this point, but if we ever did, this would be the best time to own gold and silver. Well, we got there, We've got to the point where gold, in terms of cash flow, is actually better than cash in the bank, because gold charges you about 1% to store, and cash in the bank in a lot of places is close to that and maybe less favorable than that. And so that's why so much money is flowing into precious metals recently, because people are doing the math and they're saying, wow, gold and silver are the oldest forms of money. They can't be inflated away because their supply only grows by about 2% a year. And in terms of cash flow, it's comparable to high-grade German bonds. So why not own gold and silver instead of these crappy fiat currencies, And as people come to that conclusion on a larger and larger scale, you're going to see a panic buying binge break out in precious metals. And again, that's coming too. When all of this stuff blows up, the amount of money flowing out of fiat currencies and into real assets is going to be breathtaking.
Right. And of course, if people can't make any money in the bank, they're not going to save anything. What happens to pension funds? What happens to your retirement funds?
Oh, they blow up. Pensions are completely unmanageable in this kind of an environment, because the way a pension fund works, and an insurance company, and a money market fund, all of these things take in money and invest that money at a rate that allows them to pay off their obligations in the future. And for most pension funds, they need to earn 7 or 8% a year in order to meet the obligations that they're required to meet at some point in the future. And when the safe part of their portfolio, the high-grade bond part, yields next to nothing or literally less than nothing, there's no way these pension funds can meet their obligations. So they're falling more and more deeply into a hole where their unfunded liabilities are growing, and there's really no way out for them. So we're going to see pension funds possibly be the epicenter of the crisis when the time comes, because a lot of them can't make their obligations, and it's becoming more and more obvious. So there's already one in the U.S., the Teamsters Fund, that wants to cut benefits by like half. And everything related to Chicago and to Illinois, all the pension funds in that state are in not much better shape than that Teamster Fund. So as this becomes more and more obvious to people, as more and more pension funds start to blow up, and we realize that these retirements that we thought we were entitled to and that we were going to have don't really exist. It turned out to be make-believe, that we're not actually going to get that $3,000 a month pension payment and have our health care be covered forever once we retire at the age of 60 or 65 if we're a government worker in Illinois. And we're going to actually get considerably less. And so we're not actually as rich as we thought we were. And so that's going to be a behavior change catalyst for a lot of people, because suddenly, if you realize you're only half as rich as you thought, you're going to spend less and aggressively save more. And so that slows the economy down, which makes it impossible to manage debts, blah, blah, blah. It just goes on and on. You get this downward spiral in an over-indebted economy that ends up with some kind of a 1930s-style depression. Or 1920s-style Weimar Germany hyperinflation. Those are the two main scenarios in our future. And it's not clear which we're going to end up with, but it's going to be one or the other. Or maybe both of them, but in sequence, Either way, really bad news for the average person.
Did they ever think this out when they decided to go negative?
No, there's a debate about whether this is all part of a plan being implemented by brilliant elites to basically enslave the populace, or whether it's the result of a bunch of clueless guys who really didn't know what they were doing from the very beginning, making mistake after mistake after mistake and compounding their mistakes with bigger mistakes and just blundering into a global financial crisis. I'm not sure which is scarier, and I don't have any inside information that really allows me to have an opinion. But either way, we end up with a crisis for the average person.
Apart from gold, what do? Do you buy art or stock up on something like that?
Well, you buy stuff that can't be created in infinite quantities on a government printing press. And that means real assets like farmland and really high-quality energy assets. And, yes, of course, gold and silver and collectibles of various kinds and fine art. It takes quite a bit of talent to do a lot of that, though, right? Because rare coins, for instance, are something that takes a lot of experience and knowledge to be able to correctly invest in. Same thing with fine art. You either need an advisor who's an expert, or you need to be an expert yourself to be able to build an art collection that is ideally suited to increase in value over time. Gold and silver are easier because it's just bullion. It's just fungible stuff. You buy silver coins and you've basically done it. That's the decision you had to make in this kind of a world. So, I suspect that for the average person, gold and silver will be the easiest, most popular way to protect against what's coming. But all of those things will go up over time because, remember, it's not them changing in any appreciable way. It's the unit of measure, the thing that we use to measure their value, that is going to change. And so the dollar and the euro and the yen are going to go down in value as governments increasingly, over-create currency and try to devalue their currencies in order to get out from under their debts. So real stuff that isn't increasing in supply will tend to go up when measured in dollars and euros and yen. So we'll see a rising price for farmland or for gold and silver. But the farmland, the gold and silver won't have changed. It's still what it is. It's just that the thing we're measuring them with is changing in an adverse way. So that's how you make money, or that's how you preserve capital in times of crisis. You own stuff that will tend to hold its utilitarian value over time. Gold and silver will still function as money. Farmland will still grow food, and fine art will still, give you the enjoyment that fine art gives. And because of that, those things will tend to go up in value. And they have been for the last few decades. But I think there's an acceleration coming when the arc of the increase goes parabolic, and those things just spike in fiat currency terms.
And as you said, fine art. Yes, I might have to sell off my Picasso or my Turner or my Group of 7 collection. Yeah,
and you'll be able to do that because the remaining rich people in the world will still want to buy trophies. There's always somebody out there wanting to buy the thing that they can put somewhere, show to their friends, and gain status by doing so. And so, as long as you own something that's rare and considered a trophy property, there will always be a market for that. There won't necessarily be a market for government bonds or, bank stocks or insurance company stocks. Financial assets that require a stable currency in which to hold their value, those things are going to get crushed. And so, And again, we're seeing that already. U.S. bank stocks are way down, and Deutsche Bank is at an all-time low. And that's because people are worried about the financial markets, and by implication about the big banks that run the financial markets and depend on the financial markets. So that's the kind of stuff you don't want to own. Do not go out and buy a bank stock because it has a 4% dividend. That's a really bad idea.
John, there really are trophy properties, and they're called professional sports teams.
Yeah.
Where you do...
if you've got an extra $1 billion, then buying an NFL franchise would probably fall into the category of a trophy property that exists in limited supply and that will always have a market because there will always be rich people out there wanting to own what you have.
And it seems to me during the dirty 30s, there was never more interest in professional baseball than then. The little slaves that worked for the very rich people needed some kind of diversion from the fact that they couldn't feed their family, just like ancient Rome.
Yeah.
John, thank you very much for chatting with us.
Sure, Jim.
My guest has been John Rubino. He's the author of several books on the economy, including The Money Bubble. Check out his website, dollarcollapse.com. You're listening to HowStreet.com radio. You can find us on Twitter at Talk Digital Net, or maybe our popular YouTube channel, Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.